The Inflation Reduction Act was recently released, and man, it is about as backwards as you could get. If your goal was going to be to fight inflation, there's probably nothing worse you could do than this bill. But that's politics, right? So in this video, we are going to break it down and see exactly what they plan to do in this act to fight inflation. Oh yeah, and to fight climate change. Perfect. Two things that go exactly together. Ready? Let's dive in. All right, so right off the bat, we see that this is an Inflation Reduction Act that should help ease inflation and fight climate change. Two things that are almost diametrically opposed to each other. Because if you're going to do something like, let's say, try and fight climate change, what you're going to be doing is subsidizing the cost of things like solar panels and battery tech and electric vehicles, things like that. You're going to be subsidizing the cost of those to force demand in that direction. That's going to increase spending in those directions and redirect the flow of resources to those things because now they're profitable for companies to do that, whereas before they weren't. That's not going to reduce the cost of those things. And in fact, when you have steel and cobalt and silver and metals, all of these resources being diverted to those technologies, and that's going to do is make those materials less abundant for everything else that everybody actually needs, driving the cost up higher. This is not something that's going to help inflation when you redirect resources like that, especially in a way contrary to what the free market would have done otherwise. That does the opposite of helping inflation. That causes inflation. Now, I haven't had time to read the entire bill, and you can forgive me because it is 725 pages long. That's right, a bill that's supposed to be just doing a couple of things: fighting climate change, fighting inflation, 725 pages long. I cannot wait for all of the little surprises, all the little nuggets, all the little lining the pockets that's going on in this bill that is supposed to be doing something very simple. But they do have a one-page summary, so let's take a look at this one-page summary and look at what they are trying to do and how they're trying to accomplish it. They're going to make a historic down payment on deficit reduction to fight inflation, invest in domestic energy production and manufacturing, and reduce carbon emissions by 40% by 2030. Now, none of these things have absolutely anything to do with each other, but because of the pain right now on American citizens who are experiencing a cost of living increase that they cannot afford, they are pushing this through, sandwiched together, knowing that people will say, well, fine, I guess if the only way to fight inflation is to get all of this other stuff pushed through with it that we don't want or need, they're much more likely to get it through than if they have to package it separately and vote on it individually. But let's just look at the inflation fighting portion first. What we can see here is basically the way that they're planning on fighting inflation is, number one, raising the corporate minimum tax to 15%, giving the IRS money to enforce tax laws, and then removing the carried interest loophole. Now, I've got a big problem with that 15% corporate minimum tax. Number one, it applies only to companies that have over $1 billion in profits from book income. As you can see here, this is the applicable corporations are defined as ones that have the average annual adjusted financial statement income for 3 taxable a year period ending with such taxable year exceeds $1 billion. Now, you might be asking yourself, well, shoot, if they've got $1 billion in profit, why are they not already paying taxes on that? And that's because of the way that profit is defined. You see, there's two different ways that you're going to look at profits. One way, you're going to look at it as an investor through the traditional accounting standards. And as an investor, you're going to say, hey, they're making money, so I want to invest in them. So you're going to look at that company and say, hey, they made $1 billion in profits, I'm going to invest with them. The other way is if you're the IRS, and the IRS through Congress has laid out rules for companies on what counts as income, what doesn't, and what companies are able to do in order to reduce their taxable liability. And the reason why Congress gave these rules is to try and incentivize these corporations to do things they say are good for America. They say, hey, if you invest in XYZ, if you spend your money on A, B, and C, you don't have to pay taxes on those dollars because we believe that that's good for the country that you spend your money that way. And so when we are looking at these billion-dollar companies, $1 billion in profits, this bill is talking about $1 billion in profits from an accounting perspective, from an investor's perspective. If they were talking about $1 billion in profits from the IRS's perspective, they'd already be paying taxes on those dollars. And so what they're trying to do here is say, we've spent years and decades giving you all of these laws and all these incentives that we believe are good for America for you to spend your money that way, to give jobs and to spend money and increase development and increase R&D and come up with new inventions and all these things. And now they're coming in and demonizing these companies who do that so well that they've got $1 billion of that left over to allocate to these things. So they're demonizing these people. So it's not the fact that they're tax avoiders. It's not the fact that they're running around and evading what the IRS is trying to collect on. It's the fact that they're just really good at helping out America with the rules that Congress has given them. And now Congress is trying to go and demonize and punish them for doing this. And if it really was tax avoidance, and if it really was these companies doing immoral or incorrect things with their money and just not paying what they owe, then it should apply to all companies, not just companies with $1 billion in profits or over. It should apply to all companies with those profits regardless. And the fact of the matter is it doesn't, because we're looking at things from two different lenses. They're trying to attack companies for playing by the rules that were given to them by Congress and only demonizing the large companies who have done it well. Now, all of these ways you see here that they are trying to increase their total revenue, they state this is in order to make a down payment on deficit reduction. Why? To enact a historic deficit reduction to fight inflation. So what is going on here? Why are they talking about deficits versus inflation? Well, it comes down to the way that the government gets their money and how they spend it. The government has three sources of income. That's it. There's no other sources of income other than these three. Number one, they can tax. That is involuntarily taking money from a person or a company. That's the first place they can get money, just by taking it. The second place that they can get money is borrowing, debt, issuing treasuries, issuing bonds. This is voluntarily asking somebody to give them money, then they'll give it back at a later point, plus a little bit extra. So that is the second way, bonds. The third way they can get money is through inflation, through printing it. And the government can't do it directly. They do it through borrowing from the printer. So essentially, it's the same thing as them just printing the money into existence. Every time you see a deficit here, whenever you see the federal government have a deficit, whenever you see this below the zero line, that means that they did not bring in enough income to be able to pay for their expenses. To the extent that this happens, the total money supply has to increase. Because if the government borrows money from Aunt Sally and spends it into this corporate welfare over here or this politician's pocket over here, that's a wealth transfer. The total money supply didn't grow or shrink, it just got transferred. When the government taxes and takes money from your paycheck involuntarily and spends it on those other things like welfare, Medicare, military, they are not increasing the supply of money. They're taking it from one place and spending it another place. The total supply of money stays the same. But when they bring in all the income from taxing and borrowing and want to spend more than that, they have to do that through inflation. They have to create that money in order to spend that, and then the total supply of money really does increase. Now, when the total supply of money increases, now you have more money chasing the same amount of goods and services. That causes prices to go up because you don't increase the wealth, you just increase the money that's being used to buy that wealth. That drives the prices higher. It's like taking a pizza from 8 slices, cutting 8 more slices into it. Now you've got a pizza with 16 slices, so now it just takes you 2 slices of pizza to get the same amount of pizza you got before with 1. The slices aren't the pizza, the slices just measure the pizza. The money's not the wealth, the money just measures the wealth. So ironically, this bill actually has it halfway correct that in order to fight inflation, they have to reduce the deficit. They have to stop spending more than they're bringing in. They've got to get back to a neutral budget. But guess what? The problem here isn't taxes. It's not an income problem. It's an outgo problem. They're spending too much. If we take a look at this chart of the government's federal surplus or deficit, we see that in January of this year, they had a $118 billion surplus, and in April, they had a $308 billion surplus. Looking at this quarterly, we see that in Q2 this year, they had a $51 billion surplus. Why is that? Well, it's not because tax rates have gone up. It's because they spent so much money created out of nothing into the economy. The prices went up so much that all the tax income from the rise in income, rise in the tax brackets from everybody who got increased wages, the capital gains going up because asset prices were up. They got so much money in taxes and they couldn't spend it all that they actually had a surplus last quarter. It's not an income problem. It's an expense problem. Now, technically, yes, you can push down inflation by just taxing the crap out of your country. You can take 50, 60, 70% of everything that everybody earns, and then guess what? They won't have enough left over to spend on the things they need, which will drive prices down and you'll get a depression. That's 100% a valid approach to fighting inflation. Is it the correct one? No. Could it be effective? Sure. And this is straight out of the MMT playbook. If you've read Stephanie Kelton's book, The Deficit Myth, I believe it was called. If you've read Stephanie Kelton's book, The Deficit Myth, which by the way is a garbage book, I highly recommend not reading it. This is how she advocates fighting inflation. She says, hey, we don't need to worry about deficits. The government can spend as much money as they want on anything through inflation. And the only thing that we have to watch out for is when inflation happens, or if it happens, then you just tax those areas of the economy where prices are going up too high in order to push those prices back down. So this is a page out of the MMT book. It's not about spending less and the government realizing the only thing that we do when we spend money is cause more problems. It's about, hey, we're going to take more control, and instead of reducing our spending and allowing the people to have more of what they rightfully earned and own, we're going to just reduce the amount of money they're able to keep and continue to transfer that wealth, redirect resources and capital in the economy, because we up here at Capitol Hill know better. And that's really the crux of the issue here. That is the core argument behind central planning and freedom. Central planning, whether it's the central bank like the Federal Reserve or the central government like Congress, when they decide we are going to take more and redirect it in certain ways and force changes on people, it's because people are stupid and everybody will be better off if we control what they do with their money, their resources, their time, their capital, anything that they own. Now, I get the sentiment because you look around and you see a bunch of people and think, man, people are stupid. But there's two problems with this. Number one, it's incorrect. It's not possible to make correct decisions from the top down in a more effective way than the distributed decision making of hundreds of millions of people who are basing their decisions based off their own subjective values and wants. You're going to end up with a misallocation of resources and a destruction of wealth. Number two, it's wrong, and I mean immoral. Nobody has any right to take involuntarily the property of others and transfer it to somebody else. That's it. Case closed. End of story. It's incorrect and it's immoral. And so this Inflation Adjustment Act or Inflation Reduction Act is going to try and fight inflation by putting a higher burden on the American people rather than just stopping being such a giant tumor on the economy themselves. And if we think that's going to increase economic growth and prosperity, well, then we probably deserve its consequences. As always, I really appreciate you guys. Thanks so much for watching. Have a great day.